Hello, Avila Finance students. We're now in week 6, so this is Thanksgiving week. So I hope everyone has a great Thanksgiving and is thankful for the things that they have. And I'm grateful for the financial markets that we have because without these markets and the economies, we would not be able to enjoy all the goods and services that we consume today. So we'll hope that as we continue through the rest of the year, that financial markets stay stable. So in terms of this week, we look at Chapter 12 and 13. We look at Chapter 12, we're looking at determining the financing mix. So what is the right capital structure? If you kind of go back and think about how we looked at weighted average cost of capital and calculating that, we had that pie and we said, okay, is it 50% equity, 50% debt, or 30% debt, 70% equity? So a lot of times, actually, it's the market that's going to tell us the acceptable level of debt, because at some point, you can start leveraging yourself too much, and then those like Moody's and S&Ps that look at grading debt and assigning risk to it, they're going to probably start lowering the grade. So it may go from investment grade debt to junk debt if you leverage yourself too much. So although we talk about this in theory, a lot of times it's the market that determines what that mix will be. But let's start off with just some definitions. Talked about in this particular, idea of leveraging yourself, like the use of debt. I mean, you can do that as an individual. Businesses do it though to magnify their returns. But you think about some different types of risk out there. There's business risk. You can think about the retail industry. I was reading this past week about J.C. Penney's really struggling, Sears really struggling. Amazon just changed the game. So we may not have Sears or J.C. Penney's around much longer. Operating risk deals with due to the firm's cost structure. So you think about their fixed cost relative to variable cost. If you have a high fixed cost, think about automobile industry. It may take a while before you even break even, but once you break even, it may be quite profitable. And then financial risk, the use of the debt. So that how much are we leveraging ourselves? And if we don't have the cash flows come in, how is that going to impact the firm? So, all right. So one of the things, especially in finance textbooks, compared to economics textbooks, you have what we call like a break-even analysis. It's just a general idea that, hey, if I have this amount of fixed cost and I need to cover that before I actually break even. So if you were selling, say, turkeys, we'll use that as an example for Thanksgiving, and you sold each turkey for $25, and the variable cost associated with that turkey was $20, so you're making a contribution margin of $5. And for keeping the example very simplified, say you only had fixed cost of $100. Well, if I took that $100 divided by $5 on each contribution margin, I would break even after selling 20 turkeys. And then after that, the idea that it would just increase your profit. In fact, it would kind of look linear, if you will. And that's not a realistic assumption that a lot of the finance textbooks assume, because you think back to your economics course, it was a U-shaped cost curve. So at some point, we would actually make ourselves worse off. But there's like that sweet spot in business that says, okay, here's our level of production. This is where we'll maximize profits. But it gives the owner an idea that says, hey, what do I need to sell at least to just break even to cover my fixed costs? Some other terms in this chapter talk about operating leverage. I want you to think about that as the change in earnings before interest and taxes to a change in sales. So there's kind of, again, that idea tied to fixed cost. If I have a lot of fixed cost, it may take a while before it's going to impact the break-even point. But if I'm, have a lot of fixed cost, and once I break even, I can really magnify my returns in theory. But it's just if I have lower fixed cost, I might be able to get there faster, but maybe the profit on each one is not as much. So with financial leverage, we're looking at the change in earnings before interest and taxes. Think of that as like the soup, and profit relative earnings per share. And, the earnings per share was the idea that if I kind of take this soup, and if I had $1,000 of soup, if you will, of net income, and I had 1,000 shareholders. Well, 1,000 says, hey, each share has earnings per share of $1. Okay, so, but if I'm using a lot more debt in my capital structure in that pie, well, that means that I like to use the example of like spoons for stock. And it says, hey, if I have fewer of those spoons and the soup gets bigger, that means, hey, I get more earnings per share for each one of those spoons. So using debt can leverage yourself to magnify the returns to the shareholders. Of course, there's risk associated with that because as I take on more debt, that's an obligation that I have to pay. Stock, you do not have to pay. So if you're an all equity financed all stock, if you have a bad quarter, well, that's just the risk on the stockholders. The company doesn't have the obligation to pay a bond back to someone else. So, but bond markets are heavily used to help finance companies in their capital structure. So it's just, what is going to happen as we use more debt. And then finally with that, as I kind of alluded to early in this mini lecture, is that the markets typically determine how much debt you can take on, but it is something that businesses have to make decisions about. As our interest rates are starting to rise now, probably those in finance are being a little bit more cautious about taking on more debt because they know that their costs are increasing. But after the subprime crisis, interest rates got really low. So there was a big shift to kind of use more debt in the financing structure because they were able to lock in such low fixed rates. So, but again, thinking about the right capital structure that minimizes the overall cost, because as I do take on more financial leverage, the market's going to dictate that I pay a higher interest rate. So that's actually going to increase the cost at some point. Okay, last thing in chapter 13, it talks about dividend policy. Again, thinking about that soup, if you will, I kind of think of it like what's left over in the profits. How much do I pay back to the shareholders? That's a dividend. And how much do I keep and I retain into the company to plow back into profitable projects? So that's a lot of what this chapter talks about. So questions about, does dividend policy matter? Well, in theory, there's things like that it shouldn't matter. That the value of the firm should just be based on how the company is doing, how it's managed, and what projects they're taking on. But we know that sometimes high dividends matter or low dividends can matter. High dividends might increase value because there are certain types of customers that want high dividends or increases a signal in value. Or low dividends may increase value if people believe that they're putting their money into a company that's investing in profitable net present value projects. So you'll read a lot about the different theory with that. It'll talk about residual, clientele, information, agency costs, expectations of why companies pay different types of dividends. But I would say that most executives don't like to change the dividend very much. They want something that's predictable, probably a little bit lower, and stable over time. Because if you have a bad year and you have to retrench, just like GE did, their stock's not even listed on the Dow anymore because they were going to paying 24 cents a share, went down to 12 cents a share, and now there's some question of even that, are they going to be able to pay a dividend going forward? So their stock price is around like $8, and maybe someday GE will go bankrupt. I would hope not, but it's a possibility. So a lot of this chapter looks at policy. And then the last part of it looks at the process. So, I'll give you an example, like a company I own in my retirement portfolio used to be KCP&L, GPX, now it's EVRG. They pay 46 cents a share every quarter. So right now it's trading at $60 a share. But when the company, what they'll do is they'll make a declaration date that, yes, we are paying 46 cents a share, maybe back in November. And then they'll have an ex-dividend date. That's usually a couple days before the date of record. And the reason they have an ex-dividend date is to determine who actually owns that share. So it kind of gives the back office some time to decide, who I should be paying this dividend to. So if you buy a stock on an ex-dividend date, you are not going to receive that next dividend. So that's like that cutoff date. So in theory, the price should drop to the amount of the dividend on that ex-dividend date. And then the textbook also mentions some other alternatives. It could be stock splits. which should not in theory change the value of the firm. It just gives more shares. So if you had 100 shares at $20 and they did a stock split, you now would have like 200 shares at $10. So in theory, it should not change value. But some companies like to have their stock priced at a certain dollar amount. And then some companies, they do, if they have extra cash, can be stock repurchase. So you go back to think about those shares or the spoons and the amount of soup. If I can buy back some of those spoons, that means more soup for those existing shareholders. So well, if you have any questions, do email me. But have a great, happy Thanksgiving week, and I will talk to you online. Take care.